Okay, today we are welcomed by Brian Feroldi, now a recurring guest. I believe this might be the third time.
Third time?
Second time. I know for sure second time. What was the company we talked about last time? Autodesk. We
Yes.
We were on Autodesk about a year ago.
We did that 25 stocks at Christmas last year.
Yep.
But today we are talking Zillow. Before we get to that, you recently started, maybe it wasn't that recent, but your YouTube page. How has that been going?
Really good. I started it a couple of months ago just as an experiment, basically a repository place for me to throw all the interviews I did, such as this one right here. And it took off pretty well. And it's since become a place that we go to do stock analysis. And YouTube has become a phenomenal resource for teaching people how to do a stock analysis, like in real time, showing them how to open an SEC filing, how to look at a Glassdoor rating, et cetera. So I love it.
Yeah, I love how you guys open up the SEC filings because saying all the terms, some people that it can be overwhelming at first, but if you show where to actually look, that can be super helpful.
All right, I guess we're getting into Zillow then. So just at a high level, why do you like the company, and maybe explain what they do a little bit?
I think that most people are probably familiar with Zillow. I mean, if you're a renter, or certainly if you are a homeowner, you've gotten those emails saying, here's what your house is worth. Here is your Zestimate. But I've been an investor in Zillow for at least 6 years now. And the reason I like it is it checks a ton of boxes in what I look for in a great investment. It is got a great brand. I think almost every homeowner in America is familiar with the name Zillow. And if you're not, they have over 200 million people that visit their website, unique visitors to their website every month. So the odds are very good that your listeners know, but they are becoming the go-to real estate platform, anything related to the U.S. Housing market. So it's a platform that is used by buyers, used by sellers. If you're a renter, if you're looking to borrow, if you are an agent, they have built out a suite of products that all relate to the housing market, which is a multi-trillion-dollar industry.
And they have a lot of different elements of the business. Can you go into detail on some of the important ones, and then how maybe do they make money? Because I know people know how the consumer interacts with it, but then how does Zillow, have a business on top of that?
Yeah, it's kind of got a Facebook-esque feel to it, where if you are a homeowner, there's no doubt you've been to Zillow's website to check out your home, maybe to update the page, but you're not the customer. They do have some tools that allow Zillow to monetize you. For example, if you're interested in getting a mortgage or connected with an agent, they can monetize you that way. But you are really the product. The customer, the core legacy customer of Zillow has been agents. Real estate agents can go on Zillow and they can bid to have their name put next to properties in certain geographic zip codes. And because of the extreme volume of consumers that are going to Zillow that are likely either looking to list their house or to buy a house, those are very, very high quality leads that agents are willing to pay up to get access to. So that is the historic way that Zillow made money. And that was the primary way that the company made money many, many years ago. Since then, they've offered a number of ancillary services on top of there. So you can get a mortgage through there. You can get a rental through there. They have closing services. And one of the most recent and exciting ones that they've gotten into is the iBuying service, where you can actually sell your home to Zillow. And that makes the home selling process dramatically simpler.
How do they make money on the renters side? Because I know they own, what is it, Trulia? That's
right? Zillow has been fairly acquisitive over the last couple of years. They have a number of properties under their name. Zillow is the obviously flagship product, but they also bought Trulia several years ago, that was a massive deal for the business. Zillow was number one, Trulia was number two by market share, and they combined under one roof. They also own a couple other companies like Street Easy and Hot Pads, but it's just kind of like, it's similar to like a rent.com website, where it's just a bunch of listings for rental properties. And if you go there and you book a property, Zillow gets a commission on that.
Okay, makes sense. And then what segment, I guess, do you think has the most promise for the business over the long run? Is it that iBuying, or do you think their core platform is still going to kind of drive returns over the long term?
In general, I'm a huge fan of investing in companies that have clear signs of optionality in them. And optionality is just a fancy way of saying businesses that can morph over time and open up new revenue opportunities for themselves that dramatically expand their market opportunity. So when I first invested in this business several years ago, the primary moneymaker was that Premier Agent business, again, where they were selling basically ads and connections to agents who are willing to pay up. That is still a major revenue source for the company, and it still continues to grow at a rapid pace even today. What I like about this company is that is a high margin, dependable business, and the company has been taking all of the profits from that to build out these other businesses. And it's been getting into the iBuying business, which they call Zillow offers. So if you are a homeowner and you've ever gone through the process of buying or selling a home, you know how unbelievably painful it is to try and get your home in housing market ready. Then even if you can find a buyer, which is a pain in the butt, you have to negotiate the closing date and the time. Then you have to move all your stuff out and you have to find a new place to live. It's a nightmare. iBuying services, such as those offered by Zillow, Opendoor, and Redfin, really dramatically simplify that process where you, the homeowner, are getting basically a guaranteed sale price. You get to pick the closing date, and you don't have to fix your home. You don't have to move out. Everything is, the whole entire process is made dramatically simpler. In exchange for that ease of use, you sell your house at a discount. And there are lots of people that have been proving willing to do that in exchange for the flexibility of not having to deal with any of the hassle that comes with selling a house. This started as an experiment for Zillow several years ago, where they started to buy and sell houses in markets, basically sight unseen. They're just using their own Zestimate on it. And then they invest capital into that house to fix it up and then to relist it with their agents and see if they could turn it into a profitable business. That experiment seemed to have gone well enough that the company has since committed to expanding the number of cities that it's offered dramatically. And they think that's going to be a major, major profit driver for the company moving forward.
Yeah, that's what I was going to ask was, do they just go city by city and put like refurbishing teams in those cities so that they can like fix them up? And it sounds like that's what they do. The question that comes to mind for me, it sounds like they have products or solutions that span across the entire transaction process. Mm-hmm. How susceptible is the business? And I didn't jot this question down, but is it at risk of flowing with sort of the cycle of real estate in general? Like, is it something that does a lot better when real estate is hot? Or, I mean, how does it compare to that macro environment, I guess?
So that would be kind of like best case scenario for investors, like 15 years from now. The only way that could happen is that this is a remarkably successful product. Right now, this is such a new business, and it's so minuscule when compared to the total volume of sales. I don't have the exact number in front of me, but I believe it's somewhere along the lines of 10 million houses are bought and sold in the U.S. any given year. Obviously, that fluctuates up and down, but for perspective, last quarter, Zillow purchased 3,800. So if they 10x it and then 10x it again, maybe they'll be at 1%. So the chances of them, in order for them to be influenced by the general real estate market and the seasonality of it, they will have to substantially grow that business from here.
Okay, or go ahead, Ryan.
Oh, I was gonna say, what about like the core platform, the agent partners? Is that susceptible at all to like the ebbs and flows of the real estate market, or is it kind of more recurring?
Yeah, certainly. I mean, 2020 was a very disruptive year for the business. The housing market basically came to a standstill in the early part of the year, and then it just skyrocketed in the back part of the year. Zillow, like many other companies in its position, stopped buying houses at that time. They basically paused it and they worked off their inventory. So what happened to their cash flow? It soared, right?
Yeah.
They had the ability to have soaring cash flow. What's happening today is the exact reverse. They are now buying more houses in a quarter than they're selling. So what's happening to their cash flow? The exact opposite. It's pulled back. So they can react to the market cycle that they see and what's happening. But both of those businesses are still small enough that they so far have been able to transcend the market cycle. But that is for sure something for investors to keep an eye on in the long term.
The one question I have on the iBuying thing, because I know it's so important to the growth opportunity, you described how Zillow buys from the consumer, but how do they go back to selling it to someone else? Do they have, I think they mentioned they have a loan or mortgage segment. Do they do some things to streamline that process as well?
So that mortgage segment would be a service that they offer to potential buyers. So if you were going to buy one of Zillow's houses, or really any houses, and you're looking for a mortgage broker, you can go to Zillow to get access to a number of mortgage companies to actually make that loan. But Zillow has tons of data on agents, and once they own this house, they can farm it out to their own agents, not those that work for them, but those are independent contractors. And for selling that house, the agent gets a commission on it, just the same way they would for selling any other house. What's pretty exciting about that business is when it was very, very young, a couple of years ago, the economics were terrible. They were upside down economics, which makes sense given that the company was still kind of scaling it up. But as of the most recent quarter, the numbers are starting to look good. So in the last quarter, the average house that they sold for $370,000. They bought that house for $322,000. So that's a $48,000 delta that they have on the gross profit line. Now, total costs for renovation, for selling, for holding, for interest costs, all total costs were $28,000. So that gives them a 5% net margin on their average home sale already. That's pretty exciting that they're already at that stage, given how early they are. And there is potential for them to even increase those numbers of time as scale continues to grow. But to me, as a Zillow investor, it's exciting that business is finally starting to become profitable, because for years it's been a drain.
Does that kind of have the weird accounting effect where they have to record the sale as revenue, even though it's basically the revenue, I guess, is that margin or the separation or the differential there?
I'm pretty sure they report the entire sale of the house as revenue, and
Okay.
the purchase price would be going into as cost of revenue. So they're not just reporting the gross profit; they are reporting both. So because of the nature of that business and how different the margin profile is of its core business, funny things are happening to this company's overall income statement when you kind of look at it at a consolidated basis. Like normally, I don't like to invest in businesses that are seeing their gross margin decline rapidly, but that's exactly what we're having here. The company is, but that's no secret, right? That is the nature of the business, and management has said that it's going to start emphasizing gross profit moving forward, similar to what we've seen of like Square because of their Bitcoin adventures. They're really saying focus on gross profit. Revenue is going to be all over the place. I think that makes sense. So again, normally I don't like investing in companies with declining gross profits, but I understand the reason why it's happening here.
Right, that makes total sense. And let's move to their positioning versus competitors. I know, Redfin is one that people know a lot. There's Open Door, they got a ton of money through a SPAC, I believe, and there's Compass as well. How does Zillow fit versus them? What do you think their positioning is against all those guys?
So this is something I learned when I listened to a interview that the CEO and founder, Rich Barton, did that really made me excited as an investor. There's no doubt that the iBuying industry is growing in importance, and Zillow is by not the only player here. You just named three other major competitors, and I would say that of the ones, Open Door and Redfin are the two that are well capitalized enough to be worried about. But one thing that's interesting about this new business is that it's incredibly capital intensive. I mean, incredibly capital intensive. They're shelling out hundreds of thousands of dollars for one house inventory, and then they're doing this times thousands and potentially tens or even hundreds of thousands in the near future. That alone is a barrier to entry for a potential new entrant, just to have access to that much capital. So I think that puts companies like Zillow, like Redfin, and like Open Door in a good position moving forward. If they can reach scale, it's going to be awfully hard for anybody else to break into that market. But overall, with the competition, I'll say two things. One, the entire iBuying industry is so minusculely small when compared to the total volume of housing sales. I think this is one category where there won't be one winner. I think all three of them, there's plenty of opportunity for all three of them to grow and win. But two, the thing that really struck home with me is what Rich Barton said. He says, Zillow has an unfair advantage. We have the most traffic in the industry by far. So we can take all that traffic that we get from our core Zillow properties, which again is over 200 million monthly active users. In fact, it was 245 million monthly unique visitors in July alone. That's like 70% of the entire American population that visited Zillow.com in July of this year. But that gives them a lower customer acquisition cost than anybody else.
Yeah, I read somewhere that the term Zillow is searched for more than real estate.
Yes.
Is that on the 10K?
Isn't that crazy? Yeah. Reminds me of like Duolingo. I recently did some research on Duolingo, and the term Duolingo was searched more than the term learn Spanish.
Huh. So how much?
That's a sign of a good brand.
Yeah, it sounds like that's a huge advantage. Why couldn't someone replicate that, or could someone, or I guess maybe a better question is, would someone replicate it?
But potentially. I mean, if you've been following Redfin at all, there's no doubt that they are following in Zillow's footsteps. They have a slightly different business model where they employ the agents directly, and they seem to have a nice offering. And every month they report their market share, and that's continually stepping up over time. So those two businesses are comparable. But when you think about what it takes to get access to all of the data, keep in mind that there are multiple listing services or MLSs all over the United States, and just buying and aggregating the data from all of them is a bit of a headache. Companies like Zillow have been doing this now for 15 years. So I would say that they have a data advantage, but in the long term, I think their most sustainable advantage is just their brand name. It's just synonymous with the category. Same way it would be like, okay, if we started our own social network, how the heck are we going to compete with Facebook and Instagram? It would have to be something spectacularly different. And I just have a hard time seeing another company doing that.
Does Zillow have, you said, I know they partner with the agents, but do they have their own agents at all, or is it all kind of outsourced to those partner agents?
I'm almost positive it's outsourced to those their partner agents. I know that that's different than Redfin. Redfin employs the agents directly, and they are essentially employees. Zillow does, to my understanding, Zillow does not do that.
I think we should have a quick ad break, and then we've got more questions on the back half. Okay, welcome back in. Next thing I kind of wanted to hit on is just the management and ownership. You mentioned Rich Barton briefly. I know he's the CEO. Is he also the founder? And then I guess just generally, what do you think of him as the CEO? Is it important to your investment thesis here?
Rich Barton gets 2 thumbs up from me. For those that are unfamiliar with Rich Barton, he founded another company that you may have heard of, Expedia. So he has a history of founding successful internet-based companies that disrupt industries. In Expedia's case, it was travel. In Zillow's case, it's going to be real estate. So he was already rich prior to founding Zillow, and he still has a substantial stake in the business. So as of the most recent proxy report, he owns 7.5 million shares, which at current prices is over $300 million. And this is a company that has multiple share classes. So his voting power, he has about 30% voting power just himself. Another important executive to think about is a guy named Lloyd Frick. He has also been at the company for a long time. He's the company's executive chairman. He himself owns 5.6 million shares, which is also worth over $500 million. But like Barton, he also has super voting shares. So he has a 20% voting power. So those two executives who have been in the business for a long time control about half of the total voting power. And with things like that, I check, okay, does he have skin in the game? Yes. Does he have a history of doing well? Well, if you followed Zillow stock since it came public, you probably have a smile on your face. And then how do his employees like him? Well, he's got a 96% CEO approval rating, and Zillow itself gets 4.3 stars out of 5. So Rich Barton checks a lot of boxes for me.
Okay. And what about, I guess, how big is the business? Do you want to talk kind of about the valuation and the financials a little bit, just to give the listener some context? Is it growing? And then just what does profitability look like for them?
Yeah, so Zillow is still in high growth mode. Obviously, 2020 was a weird comparison year just based on the nature of the business. And the other thing that people, investors have to keep in mind is the margin profile of the business is changing dramatically. So revenue growth is going to be extreme as the iBuying business continues to ramp up. For example, next year Wall Street's expecting almost 50% revenue growth for the business. However, it's really going to be, well, how fast is gross profit growing that we as investors should really focus on and care about. Now, because of that, and because of the nature of the iBuying business, the price to sales ratio is going to be misleading on this company. You can't just take it and compare it to like a high growth SaaS company and say, well, those two are comparable, because again, the margin here is going down and trending probably to settle around, I don't know, somewhere around 20, 30% in the grand scheme of things. Whereas, you compare that to a high growth SaaS company with an 80% gross margin, of course, they're going to trade at different price to sales ratios based on that. But if you look at the price to sales ratio, it's currently under 6, which is, reasonable, I would say. But the price to earnings ratio, company does have a PE ratio that you can actually look at. Its forward PE ratio right now is about 63. Once again, I would argue that this company is not yet fully optimized for long-term profitability. So that number is a bit inflated compared to what the real earnings power of this business is. But right now, I don't think this is like insanely expensive.
And how does their cash flow kind of deviate? So when they're like a net buyer on Zillow offers, does that really kind of tank their cash flow? Am I getting that right?
Yes.
Okay.
Oh yeah. This is a business that's going to be yet another case study in the difference between net income and free cash flow. And it's really based around the iBuying business. Again, the iBuying business is incredibly capital intensive. So last quarter, they bought 1,800 more homes than they sold. So that's 1,800 times, what was their purchase price? $322,000. That's a lot of cash that's going out the door. Normally that really bothers me. I don't like seeing a big discrepancy between free cash flow and net income. And when choosing between the two, I'll take free cash flow every single time. I think offsetting that is the fact that if Zillow wanted to become free cash flow positive at any time, it could. And we saw exactly that happen in Q1 and Q2 of 2020 when the world, was falling apart. It said, all right, we're stopping buying homes. And then free cash flow just absolutely skyrocketed. But again, that is something that I think is a long-term barrier to entry for anybody else that wants to get into this business. You need a ton of capital to do so.
Right. And one question I think we have on the offers is, do they give any color on the turnaround time between buying and selling? Because if that can compress over time, that would theoretically help the working capital improve.
Yes, I don't know that off the top of my head. So, but I think that's something that you could look up.
Does it? When I hear about the Zillow offers business and just the iBuying in general, the first thing that comes to mind is like they're holding these essentially a bunch of homes on their balance sheet at one time. Do you think that adds some risk to the business? Or I guess we just talked about.
Or what are the risks?
What are the risks associated with that?
Yeah, the risks is that Zillow offers doesn't work out. I mean, make no mistake, this is a massive business model shift, and the company hasn't yet proven out over a long period of time that it can work. In some ways, it reminds me of Netflix a few years ago when it really started to invest heavily in its own streaming and internal production capabilities. We saw a massive discrepancy for years between net income and free cash flow because doing so was incredibly capital intensive. Zillow is still in that early part of the cycle where it's probably going to be free cash flow negative for quite some time as it ramps up. I hope eventually it reaches a tipping point where it has enough scale where that cash flow balances out and then it can grow itself. But again, that's the reason why I like this business versus Redfin and versus Open Door is it has that cash cow internet media and technology, the premier agent business that can kind of fund all the development, all the build out of the Zillow Offers business. But make no mistake, this company does not have a long operating history of making the iBuyers business work. That is a massive risk for investors.
Is the premier agent business, or the IMT part, is that still growing?
Yes.
Okay.
All right. And okay, one more. You talked about iBuying. That's the one that, most investors are aware of. That's the big growth opportunity. Are there any other segments of the business that investors should be aware of before investing in this company?
Yeah, all the companies' revenue sources are all in growth mode. And if you listen to management, they believe that their internet media and technology business still can grow at an above average rate for years and years and years to come. They think their total addressable market opportunity there is far bigger than what they've captured already. But all those other high margin businesses that they have and they're scaling out, the real plan there is take those profits and use it to fund Zillow Offers. That is the plan. The early signs are that plan is working, but wow, there's no guarantees that it will continue to work into the future.
So one question that comes to mind then for me is that, let's say the three well-capitalized players like Opendoor, Redfin, and Zillow, they all start to go full growth mode on the iBuying process. Does that start to, I think the part that excites people is that they can buy these homes at a discount and then obviously sell them for more. Would that start to go away with competitive offerings if Opendoor and Redfin are also competing in the same market, or is it kind of a big enough opportunity that it doesn't matter?
I would say the latter is what's happening right now. The opportunity itself is so big that it doesn't matter. But then again, if you were going to be selling your home, I know I, for one, would certainly want pricing on all three of the sites. I mean, that is a tens of thousands of dollars decision between them. So there will be some competition between each of them. Again, I think that Zillow has the advantage in that it has the lowest customer acquisition costs, and it's got the most traffic. So it can drive the most traffic to its iBuying sites. But again, that's something for investors to watch.
All right. Do you have any others, or should we go to the
checklist
one?
Yeah. How to do on your checklist?
So I have a pretty detailed checklist that I take every company through. And if a company scores below essentially 70, I ignore it. Between 70 and 80 is really good. And anything over 80 is, why don't I own this? A few years ago when I did this, Zillow was just a business focused on the premier agent business. And at that time it was in the low 80s. And that was like, why don't I own this? Hence why I became a shareholder. More recently, with the business model shift and with the dynamics around free cash flow, it's lowered its quality rating to being, last check, it was a 77 the last time I did this. So this is still in my highly investable category, but it's riskier, I think, today than it was a few years ago.
Right. And you've done a video on the checklist, right? So people can know how, all the inputs of that.
Yes, we have done many videos on taking companies through the checklist. So check out my YouTube channel if that interests you.
All right.
So on Zillow, I don't know if you have it in front of you, but what were some of the knocks on the business? What dropped it down to a 77?
The biggest one there was a shift in free cash flow. So they were formerly producing lots of free cash flow and growing it rapidly. Now, because of the dynamics of the iBuying business, their free cash flow is negative. The other thing that I don't like is the company's the dilution rate has been pretty high on this business. Part of that is due to their acquisition strategy and some of the acquisitions they've made in their past. And another part is just stock-based compensation. Those are the two biggest categories that I knocked them for. On this round, but still, this company still checks a lot of boxes for me.
Yeah. So what's in your mind, they're doing this business model transition at this time period. What's the biggest threat to the business? What could go wrong for investors over the next, 3 to 5 years or just as shareholders?
Yeah. Make no mistake. A bet on Zillow today is a bet on Zillow Offers, period. For this company, for this investment to work out, the company has to continually grow that business and do so while producing profits. The recent signs suggest that the economics for that business are starting to become favorable, at least on a net income basis, but they are going to be pumping tons and tons of cash flow from operations into that business. And to your point, they might even be raising capital again. So the last time that I see that they did that was May of last year, which again was in the middle of the world falling apart, and real estate being upside down. So that makes this a high quality yet risky stock, because if this thing is going to multi-bag, Zillow offers worked out. If it's going to underperform, it's because Zillow offers didn't work out. Period.
All right, that's a good way to wrap up, I think.
Yeah, I think that's all our questions. Where can listeners find you? What's the YouTube channel called?
YouTube channel is called Brian Feroldi, and I'm most active on Twitter, which is at Brian Feroldi.
That's right. Great graphics for anyone who's trying to learn about the stock market.
All right. Well, that's going to do it. I'm going to try to hit the disclosure without butchering it here. So we are not financial advisors. Anything we say or discuss here on Chit Chat Money is not formal advice or a recommendation. We are, however, general partners at Arch Capital. So clients may have positions in the securities discussed in this podcast. Thank you for listening. We'll see you next time.